All right, Itai, take it away.
All right, we got a lot to cover. So I will be somewhat quick, but I will leave a lot of room for questions and discussion. Worst case scenario, we'll do it in a two segment if there's a lot of questions on this. So can everybody see my screen? Yeah, thumbs up?
Sure can.
Let's make this a little bit of a presenter style. All right, Equi University, November 1st, 2021. As Jeremy said it so well, we are Equi, your digital family office. So let's start with a little bit of a macro update into interesting things that are happening in the background of markets that you don't necessarily see in your Bloomberg and CNBC updates. So I wanted to talk first about some of the reasons I think markets have had such a phenomenal 2021 in general. We do know the markets are tracking for a very, very good year, but also why I think 2022 may not be quite as smooth sailing and easy as 2021 was. So first of all, buybacks are back big time. If you're talking about demands for equity markets and reasons for pushing and propelling stocks higher, up until February 8th this year, has already broken all records of all prior years is the amount of companies that are buying back their own stock. So over 884 billion, and we're on track to have over $1 trillion worth of buybacks this year. Truly, truly phenomenal. And it's definitely increases demand for equities and actually making equity multiples look a little bit different too, but I won't go into all that. And you also have to realize that the end of the year sees interesting flows as far as mutual funds and how actively managed funds AUM look like. So actually almost a quarter of the equity flow comes in October, gets deployed into the end of the year, into November, and a lot of it comes into December as well. So at the same time, you've also seen inflows breaking multiple record inflows into equities, also approaching $1 trillion. So liquidity and money just getting pushed into risk assets from all places. And I'm sure a lot of people that are in anywhere from VC to real estate are feeling the impacts of all that liquidity just getting pushed into risk assets. So let's talk about some seasonality. We're actually here at the beginning of November. If you're looking at an average of all days going back to 1928, and you're just averaging those data, you will see that there's a strong positive seasonality from the end of October into the end of the year because of all of this dynamic of when money flows come in and how things get situated. Okay, at the same time, we're also seeing some positive for markets, I would say, developments on the political side. The prediction markets now say that there's effectively no chance at all, or 93% chance that there will be no corporate tax increase at all, which is a substantial change than what we had a few months ago. All right, so that was all the positive side, and we can cover a little bit of what can go wrong. Before we get there, just want to see if there's any feedback, comment, or question about any of these things. Awfully quiet today, Jeremy.
I know, it's a rough crowd, man. Woo!
Okay, let's talk about earnings now. We're seeing Q3 earnings, and when you're looking at earnings per share revision for post-COVID quarters, right now the third quarter is tracking to be the weakest earnings season since COVID. So we've had the bulk of the rebound effectively already taking place. And when you're looking at the right-hand chart, these are estimates and revisions for both 2021 and 2022. Typically, there's a bullish tendency there. So revisions keep going up as corporations tend to do better and profits increase over time. And we've seen both for 2021 and 2022 earnings revisions are now plateauing, signaling that earnings may have peaked and the bulk of the post-COVID rebound may have already occurred. Interesting to see that little blip when Tesla becomes a member of the S&P 500, and of course it doesn't have as much earnings as some of the other companies, and it actually puts a dent into earnings revisions.
So it seems like there's some upward pressure because of the money that gets deployed, but at the same time, you kind of have this earnings plateau, which could potentially signal what, a market top?
I mean, historically, earnings are somewhat correlated with stock prices. There's obviously liquidity and other things that matter, but when you have enough things that stack potentially against it, I think the case I'm trying to make is that 2021 had just huge flow of liquidity from everywhere in all these places, and I don't think 2022 will be quite as easy as 2021 was. All right, so you see that in the earnings here, you're seeing earnings growth and revenue growth, and they did seem to peak just about now. So that goes back to that narrative. Now, this is, I think, is the most interesting chart of that. As you well know, you can correlate the performance of the stock market with the Federal Reserve balance sheet, or basically the amount of bond purchases that the Federal Reserve does. So again, they're basically creating money out of thin air through the quantitative easing programs, or QE, and then they use it to fund basically government bonds that give money to the federal government that they can spend to do whatever programs they're doing. So for the first time since the beginning of the COVID era, next year we are expecting to taper quite extensively. So as of right now, the Fed is still printing about $120 billion a month. Yeah, that still is happening, but potentially going to zero by August. So pretty aggressive tapering in that first half of 2022, and really removing a huge amount of liquidity from the markets as of right now. And it's a fair question. I've been asked this before, so just wanted to bring that up. I think it is interesting to know that even though the Fed is tapering to net zero in August, that doesn't mean that there's no Fed intervention at all, because the Fed is still taking the proceeds from those bonds. So imagine when you're buying $5 trillion of bonds, even 1.5% can be quite a bit of money. And then they use that money to reinvest it and buy more bonds. So
you're basically saying that they're ending the QE tapering, but really they're continuing it with all the interest income that has come in from the purchases over the course of the past year.
Yes, that's exactly what I'm saying. So on a net basis, you're still having about 50 billion worth of QE that is expected to happen. But keep in mind that this schedule doesn't include the reinvestments that are happening already. So you're still getting to net zero of new purchases, but you're still reinvesting. And that's nothing new. They've done that in the past. So when you're looking at their total holdings starting here in 2013, so here we had the first taper, and it started at 5 billion per meeting, and then eventually QE3 got tapered away. And then the Federal Reserve balance sheet stayed flat for 3 years because of the reinvestments. And then they let the balance sheet run off, and they actually reversed it with QT. They totally reversed on that experience, and that experiment for them did not end well. And the balance sheet exploded as a result of COVID that we all know. And this is where the projection is with taper. And then the reinvestments would just probably keep it flat.
And Itai, just a quick reminder, how has the S&P 500 performed in those situations when the balance sheet stays flat?
It was a lot more volatile. So if I would put a chart of the S&P on top of what we're seeing right now, 13, 14 were very bullish years. 15 and 16 saw a lot more volatility with the Chinese yuan devaluation. 2016 had some volatility as well. So 17 and 18 had the tax cuts that added liquidity, not via the Fed, but via the fiscal stimulus. The market did very well. 19 and 20 were a lot more volatile as well. And then of course, 21 has done exceptionally well as liquidity is abundant. So it seems like there's some correlation there with that happening. So 2022 may be a little bit more volatile. Now, at the same time, we also have the probability of a Fed rate increase substantially going up. So you see here on the y-axis is basically the potential Fed funds rate, right? And here are the months. So here's January 2022 going all the way to December. So we're right now in November. This would be about a year out.
So this is basically saying, hey, right now the current predictions as of a few days ago is that by December of 2022, the estimated federal funds rate will be somewhere around 60 basis points, which would be what, approximately almost 3 rate hikes, because they do it in 25 basis point increments.
Yeah, between 2 and 3, probably closer to 2, but potentially up to 3. But what is interesting is not the actual rate hike, but the difference from just a month ago. So you can see a month ago, the market was barely pricing 1, and it's risen substantially. So on one hand, you're seeing the Fed going to net zero by August, and at the same time, potentially up to 3 rate hikes. So I think the Fed is, or at least the markets are saying that, we are seeing the markets taking the inflation more seriously.
Yeah,
and
that sounds like potential risk to come, as there's been more volatility when the printer is not going, and now you add in increased interest rates. There could be some unique things happening in the market.
And I think the main reason is really the divergence with break evens. So I'll explain what they are really. You have 2 main, call it pricing of inflation. On one hand, you have that 10-year treasury, which is very, very important. The 10-year treasury is the price of money itself. So everything is really priced based off of it. If it's a mortgage for your home, all the way to the equity multiples that you're seeing on some of the tech companies, that they are also correlated with the price of money or the 10-year treasury. Now, on the other hand, you have TIPS, which are treasury inflation protected securities. So when you have a substantial gap between TIPS and 10-year, that means the traders for the TIP market are potentially saying, hey, there's a risk of inflation over what the 10-year treasury is saying.
Why don't show us the graph and let's talk about it graphically. Maybe call out the color of the lines and we can talk about it.
Okay, so on the blue line, what you're seeing here is the actual 10-year treasury. And then the white line is the break even, or a spread between a 10-year treasury and the TIP. So here is that last tapering. 2013 is when the Fed said, hey, we're going to taper the bond purchases, and there was a substantial spread between the TIP market and the 10-year treasury. Now that spread closed as they move alongside very, very, very well, because it makes sense. On one hand, you have a market that says, here's the yield for the 10-year notes market. And on the other hand, there's a market that says, here's the expected inflation 10 years from now, or what that's going to annualize at. So right now, that gap in TIPS to 10 years is over 3.5%, where the 10-year yield is still at 1.5%. So that potentially shows a substantial risk of interest rates being way too low for the state of the economy.
So you're saying that normally these two should move in conjunction with each other. They've spread apart through the printing, and now all of a sudden you're getting to a world where we're about to get back to tapering, and you're saying that the 2 of these lines could potentially converge again?
Yes, that's what I'm saying. Either with inflation lowering, or with a mix of the 2, or with the 10-year going up.
So that means that in order for them to potentially converge, either you have to have the 10-year treasury rise, which means a corresponding rise in interest rates across the board, or you need to see a decline in the TIPS to actually move down, or some combination of the 2.
Right. So in 2013, you saw a combination of the 2, for example, where TIPS fell and rates went up. With this is the so-called taper tantrum, where interest rates spiked very, very quickly, about 100 basis points in 2013. So I think a scenario like that today would potentially be fairly problematic for risk assets.
And one last quick question. This TIP market, it is projecting inflation to be at X number for how many years?
That's 10 years right now. That's the 10-year break even. That'll be your average. So
is it saying that the expected inflation is going to be at about 3.75 for the next 10 years, or a higher number than that?
No, that would be the number. So again, remember that this is the break even. So that's your spread between the 10-year and the TIP market. So that's telling you that that is the expected spread, but it means that there's a good chance of inflation being a lot higher than what the 10-year treasury is saying.
Understood.
Okay. So this is going to be our first quote stagflation chart of the day. And I'll explain in a second what that means. So this is your time axis in X, the X-axis, starting here in 2010, going here to 2021. And in purple, you're seeing inflation surprises. So that means that when inflation is above consensus expectation of analysts, it's an upside surprise, like here. When it's below, it's a downside surprise or a deflationary surprise. Now, on the yellow, you're seeing the economic macro surprise. So when it's higher, that means that the economy is doing better than what analysts expect. And when it's lower, that means it's doing not as good as analysts expect. So typically what you see is that inflation and economic surprises go hand in hand, because as the economy does better, there's more demand for goods and services. And as a result, there's more inflation. Everybody makes more money. There's wage inflation. Everybody wants to buy more stuff. Things are going great. But it gets very interesting when inflation has a positive expectation or above what people estimate, but the economic surprise is negative. So that would be what we call stagflation. And right now, we've seen some of the very first readings that indicate that something like that may be going on.
Got it. So our orange, yeah. Okay, no, you keep going.
So let's talk real quick about what you started the call with and how markets can potentially reprice very quickly. So what you're seeing in purple here is your UK 2-year yield, very, very short-term yield. And then what you're seeing in yellow is the Australian 2-year yield. So as you said very correctly at the beginning, the 2-year yield for the UK is just around 75 basis points, and the Australian one is around 56 basis points. So what happened is that the Australian central bank said all of a sudden that they're not going to offer to buy that 2024 bond that they keep as far as their yield control program. So that means that they were trying to control their yield curve, not letting some bonds be over the top over other maturities. They were keeping them with a spread of 0.1%. And all of a sudden they said, you know what, we're just not going to do it anymore in their last meeting. And within minutes, there was a 5 standard deviation move, which is supposed to happen under normal conditions, I think about 0.001% of the time. And many funds obviously lost a good amount of money on that if they are trading various mean reversion strategies or were playing the yield curve or the bank's yield curve control. And within minutes, really, the market repriced everything in Australia. Now, in England, something similar happened where the governor said that they will probably have to act on inflation soon. And within a very short period of time, they've gone from 0 to 75 basis points on that short-term 2-year yield. And the LIBOR in the UK had an 8 basis point move for 3-month LIBOR. Now, that doesn't sound like much, but that's the biggest one-day move since Lehman.
All right, Itai, two good questions. First is, did both abandon their peg for, or both abandon the yield curve control for the same reason, to curb inflation?
It seems that way. It seems that they're realizing that inflation may be a bigger problem than they anticipated. And I think one of the biggest risks of having, or the fact that most of the developed world had such a loose policy post-COVID, they really didn't think inflation is going to be a problem. And if it is a problem, one of the biggest risks is that central banks may slam the brakes too fast, too hard on the economy. And that could create problems in the future if that is in fact the case. So I just wanted to show an example of how quickly markets can reprice if they're given new information.
Got it. That's really interesting.
All right. So our main topic, what really is stagflation? The classic definition of stagflation is when you have inflation rising, so prices of goods and services are increasing, but at the same time, the economy slows down and is doing not so good or less good. Unemployment rises and other things become a problem. Now, in classic economic theory, that was impossible. That was thought of being impossible. And why is that impossible? For the same reason. If the economy does well, everybody's making more money, buying more stuff, you get inflation. So how are you able to have a slow economy where things are not doing well and still have inflation? Because in classic economic theory, if things are not doing well and people are buying less stuff, eventually prices are going to fall because there's going to be less demand. So those two things seem like they conflict. And in classic economic theory, they shouldn't exist. And yet they did happen in the 1970s, which brought, the discussion of, are we seeing somewhat of a repeat of that in what we're seeing today? So why is stagflation such a terrible thing? Why is it so bad? Why is it potentially a lot worse than just inflation or just deflation? And the main reason is that the two sets of tools that policy has, that monetary policy has, to fix, or even fiscal policy to fix the economy, they conflict here. So if you want to fix inflation, what do you need to do? You need to raise interest rates. You need to taper QE if you have it. But if you do that when the economy is already weak, then you're potentially going to take a weak economy and sink it even further. So that's really bad. But then what you use to fix a weak economy, which is you lower the rates, you do more QE, you do fiscal stimulus, that can cause inflation to spiral out of control if you already have inflation. So what do you do?
Damned if you do, damned if you don't.
And that is why stagflation is such a terrible thing. So when economists really have two theories of what caused stagflation in the 1970s, and let's talk about what those are. So on one hand, it's the policy mistake. And how can you create too much inflation in the economy? That's kind of how it starts. And it really comes down to putting too much money in the economy too quickly in one fell swoop. It's not raising rates fast enough when the economy does heat up. And we talked about monetary policy, which is what the central bank does, but also the government has fiscal policy. And basically when the fiscal policy is just too loose in a period that's already inflationary, they're putting more fuel on the fire. So that would be considered the policy mistake. I do love that picture though.
It's an incredible picture.
And the second thing that happened in the 1970s and arguably is happening right now as well is the supply shock. So what causes inflation? For whatever reason, there's a sudden loss of supply and supply chain disruption. And as a result, you're seeing a rapid increase in prices just because supply was disrupted. So prices can go up for two reasons. You either have increasing demand or you have decreasing supply, right? Or you have a combination of the two. So the 1970s famously saw a massive supply shock. So let's talk about how did we get that inflation in the 1970s. So the Johnson administration started a lot of fiscal policy with the Great Society, which was substantial welfare program, expansion of Social Security, etc., and also spending on the Vietnam War. And then very famously, 1971, the gold standard ended and Nixon just suspended the convertibility to gold. For those of you that are interested of learning more about it, we did a pretty extensive 3-part series on the petrodollar and how we ended up being in a dollar-based system in which commodities are traded for gold. It's super interesting and it's related to this. So I recommend listening to that if you're interested. And there was a lot of bad weather really in 1972, which drove up food prices. So it's kind of like the perfect storm of everything happening simultaneously. And then the dollar went through another devaluation in 1973. And then you also got a massive oil shock. So all of a sudden, boom, supply was taken away because of OPEC embargoing Western nations in 1973, and then a second one in 1979.
You must be hitting better with the millennial crew, because I asked in the chat if anybody remembers actually living through stagflation and what that experience was like, and I got nothing.
I guess that tells us, look, for me too, I mean, I only know about it from studying the past, right? Hopefully we don't see a repeat of that, but it's good to basically study previous cycles just to see what's possible out there. So it's interesting to see really inflation prior to 1971. That's kind of that magic date because the gold was fixed. The dollar was fixed against gold. And then what happens from 1971 onward, where inflation just becomes much more permanent. I like this chart where you're looking at a can, basically Campbell's tomato soup. You do have that concept of shrinkflation, where they basically charge you the same thing, but they give you a smaller package size. So they don't do that. They don't do that here. And you can see basically prices prior to 1971, very, very stable, basically not too much inflation, and then post 1971.
See, I can't imagine how the price basically stayed the same for what it looks like the better part of 100 years prior to 1970. That seems crazy.
Right. But keep this in mind too. Between 1910 and 1970, you only had about 300% inflation in that 60-year period. And then compare that 60-year period with this 60-year period. Or 50-year period, right? You have way more inflation after we went into a fiat system.
And it's fiat being getting off of the gold standard and being in the era of being able to print the money.
That's right. All right, so now let's talk about that supply side shock. What we're seeing here is the two shocks on as far as the price of oil. So oil in 1973 was about $4 a barrel. And then it goes from $4 all the way into about $40 a barrel by 1981. But really that first shock already takes it, 3 to 4x. And what's interesting is that the Fed chair at the time, Barnes, he said that monetary policy had nothing to do with the shock because it was all related to OPEC. So oil produced, everything related to oil and energy products should be taken out of CPI for analysis. And then he wanted to do the same thing with food prices because of the unusual weather. It's like, that's not CPI either. So he really wanted to take away 2/3 of CPI. And what's really interesting is that he called them all transitory, but you can see that after those shocks did occur, even after supply normalized, prices never went back to where they were. They stayed really elevated forever, really, until now. So let's talk about the COVID supply chain shocks then. Do we have a repeat of that at all? Do we see anything similar? So starting here, 2005 till now, basically this is mentions of supply chain issues in corporate earning announcements. So, a company announces their quarterly earnings. There's usually a conference call down to investors, lasts an hour or two, and they talk about their business, what's going good, what's going bad. And you can see the amount of companies now mentioning supply chain issues in their corporate earnings is just staggering. We really see that in the auto industry, where the price of used cars is now 55% higher than what it was in 2020. And even though plant hours in the US for semiconductors and other factories have really gone up to accommodate for some of that, we're still not seeing any real slowdown in the price of cars or used cars. And it's really crazy to see that chip shortage that's happening and how that's creating a supply side shock.
Anecdotally, I know you just sold your used car for what, more than you actually bought it a number of years ago?
I got 20% more than what I paid for it in 2017.
Crazy world.
Crazy world. And we're seeing a massive increase in demand for labor, but mainly labor when it comes to transportation and warehousing. So all these things that are related to the supply chain. This is the cost of freight, basically the cost of sending and shipping something from China. And you can see how that massively increased in 2021 as the economy reopens.
When you talk about the cost of shipping, is this the cost of the underlying container?
Yes, renting storage and container space.
I understand. And one other question, going back to your last graph, I keep hearing about the labor shortage, but at the same time, there's all this wage inflation happening. Do we have any clues as to why it seems like there's such a shortage of labor out there to fill the open jobs?
There are theories, but there's no distinct answer into, it's mainly COVID related and then government stimulus and maybe, boomers retiring from the workforce or people less willing to take lower paid jobs. It's a mix of things.
Got it. Thank you.
Okay, now this is one of the things that really is stunning. This is the amount of ships that are currently just anchored in the LA Long Beach port, waiting to have merchandise in the tons and tons of tons offloaded into that port. At the moment, there's just about 100 massive containers just waiting out there. And you can see that prior to 2020, that was never really an issue at all. That never even existed. And now it seems like it just keeps accelerating and there's no solution in sight. And talking about that labor shortage. So what you're seeing in light blue is small business job. Basically, small businesses are surveyed and they're being asked, hey, how hard it is to fill a job in your business. And then in the dark blue, you're seeing the Fed funds rate. So in the past, those two were very correlated because that's a measurement of how hot the economy got. And as a result, the Fed would raise interest rates and then that would cool off and they were correlated. But now we're seeing a massive divergence between the two. So that is implying that the Fed is behind the curve on one hand, but then on the other hand, you're seeing a record amount of small businesses saying it's very hard to fill jobs, actually more than 50% of small businesses out there. And that, of course, leads to our wage inflation. So wage inflation now is averaging 4.6%, which is a cycle high, really. And a lot of it really comes down to those lower earned wages that we haven't really seen a lot of wage inflation over there. So this is new. So let's talk about the monetary policy in general. Monetary policy right now is, believe it or not, as loose as it was in the 1970s, even a little bit more. And the way to calculate or look at it is not look at the pure 10-year treasury or look at the inflationary rate. An interesting way to do that is actually look at the Fed funds rate and subtract CPI from it and get an idea of what the real rate is. So in 1975, if you have your money in the bank at the current rate of inflation versus the Fed fund rate that was a few percentage points, your real rate would be around -5%. So you'd lose 5% when adjusting for inflation. Now today, it's very similar. You would lose around 5 or 6% for cash sitting in the bank after adjusting for inflation.
This is your Tina, there is no alternative.
Right, which explains the beginning chart. We're seeing this massive inflow into equities and things like that. So monetary policy, again, as accommodative, providing a lot of support for the economy. There's a reason there's a dove here and not a hawk.
It's a beautiful picture.
Okay, so I'll skip this. Basically, the idea here is that this is a discussion of QE. So I've gotten a question last week, basically asking me, well, when the Fed was doing a lot of QE in 0809, that didn't really translate into inflation. Why is it doing so now? So this is really the reason. When the Fed does QE alone, and it's not, you don't have fiscal policy that corresponds with it, it really just recapitalizes the banking system. So what you're seeing here in the red is the amount of collateral that commercial banks hold. So the JP Morgans, your Citis, your UBSs, whatever, that's what they're holding in their bank as collateral, treasury securities, etc. And then in blue, it's the cash amount that they have in assets, basically their required reserves that they need to carry. So in 2008, the banks were very low on cash and very low on collateral, which is why they were all defaulting. And then the first QE comes in, and what it does is it really recapitalizes the banking system and puts them on life support and gives them enough money to sustain. So ever since, the Fed just made sure that the banks don't fall below this level, and collateral now is really at an all-time high. Banks are sitting on a lot of cash and a lot of collateral.
So making sure we translate this to regular speak, they're running QE, they're filling the banks with liquidity, they're lending it out. Those lending are finding their way back into the bank in the form of deposits, increasing their collateral. And then whenever the banks need more liquidity, the Fed is just pumping more cash into them.
Very, very close, with the exception that it goes directly to the banking system and doesn't really end in customers' deposits. So the banks themselves sit on the collateral as far as their commercial bank and the commercial amount of cash that they have, but they're actually not lending it out and they're just sitting on it. So you can see that in the following chart. Starting here in 1999, on one hand, you see the aggregate amount of deposits in the big four. So JP Morgan, B of A, Citi, and Wells Fargo. They have $7 trillion of deposits, but they're only lending out about half of it into the real economy, 3.5 trillion. And when does that divergence start? Up until 2008, they were basically lending everything they had. But starting 2008 onward, deposits just keep growing, but the loan amount actually declined in the last couple of years. So there's less demand for loans, believe it or not. And the difference this year is that you're really getting QE, which puts a lot of money in the banking system, and fiscal policy at the same time. So in 2020, banks had a ton of reserve. They actually didn't need QE at all. The QE went to the underlying economy and not to the banking system. And as a result, that's really what you're seeing, that difference in M2 money supply. So this chart shows you M2. M2's definition of money supply is cash and also amounts of money in deposits. So what happens in 0809, even though there's massive amount of QE, you don't see a huge increase in M2 because the money doesn't go into public bank deposits. It actually just goes to the bank themselves. But 2020, you're getting $1,600 stimulus check or $1,200 stimulus check. You're getting huge amount of unemployment benefits, and you're getting all this money into that the government's giving to people directly. And then guess what? They put it in their bank accounts, and that causes the money supply to blow up.
So are you then saying that M2 is rises in M2 are probably a better predictor of changes in inflation? Is that what you're trying to get at here?
Yeah, so very large expansion of M2 because of that mechanic translated to inflation. So that shows it better. So I'll explain what all these lines really mean. Blue, you're seeing the deposit in all the commercial banks in blue, right? And then in red, you're seeing the total assets. And then in green, you're seeing government transfers. Government transfers, meaning here's your $600 stimulus check. Here's your $1,200 unemployment benefit, or whatever it was. So you're seeing that QE in red, basically, when it happened in 0809 and when it happened in 2013, stays in the banking system because you don't see the green government transfers at all. And you don't really see the blue line, which is the total deposits go up. But then look at what happens in 2020. All three lines explode. And as a result, we actually got real inflation. And you see that here in that CPI. Eurozone CPI even goes up. Amazingly, Japan still doesn't get inflation.
Those are some strong negative demographics working against them.
Amazing.
You know, Itai, I got a question that came in privately, which is saying, in layman's terms, you're putting all these graphs together. What's happening and what will happen? Like, what are you seeing here?
Right. So let's talk about
everything kind of in general.
Yeah. So let's try to tie in that point. So let's compare some of those macro factors between the 70s and 2020s and see. We're really trying to answer the question, are we seeing normal inflation? Are we seeing transitory inflation? Or are we going to see potential stagflation, which, none of us really want to see, but it is possible for at least a short period of time. So one of the biggest differences between the 1970s and what we're getting in 2020s is really the debt level. So post-COVID, the debt is almost as high as what it was during the peak of World War II. There's no other period that really has that amount of debt. But debt in the 70s was really low because we still had the gold standard until 1971. And that kind of prevented massive accumulation of debt. So it's going to be a lot harder for the government to tolerate higher rates, which means that the policymakers are pretty much, the Fed is forced to stay behind the curve. So when you're looking at all this potential tapering of QE, and you're looking at this increase in interest rate, I do think that the risk of not stopping inflation rather than stopping it too hard, I think that the risk falls into letting inflation run too wild because the debt burden is too high.
Got it. So you're saying, let's just take a step back and pause to make sure I'm understanding this. So you're basically saying, hey, in a normal economy, if you saw this type of action happening, the immediate action would be to raise interest rates to curb some of the inflation. But right now we have a debt burden where the federal government has a bunch of floating rate debt. And then all of a sudden, if the interest rate goes up, the cash payments they have to make also go up, which is something that they don't necessarily want. But you're basically saying, hey, the worst outcome that would potentially happen is too much inflation. And if you don't raise interest rates, then you got a system that unravels. So what does that mean for everybody's portfolios here? Like, how should they be thinking about this?
I think that means that the risk of substantially higher volatility than what we've gotten used to is much higher.
So more fluctuation. If you're owning equities, expect for a lot of fluctuation up and down. Right?
If you look at the 1970s market, what did equity markets do during the 1970s? The answer is nothing, but that nothing had about 2 or 3 up down 50% moves.
Okay, so you might have a crazy ride up and down, but not necessarily see much of a change in your portfolio value. Is that right? Those are the types of things that could theoretically happen, right?
I really think so. Yeah, if stagflation is really what we're going to see, there will be, the smooth sail up that was so easy in recent years may not happen in the 2020s.
So then, are you saying that there should be some type of maybe rotation out of equities and maybe into alts or other types of investments that might have lower volatility?
Well, we've seen that with institutions and large endowments and things like that. I mean, this is why they're already 50% in alts, and they realize that they don't want to have too big of an equity exposure or things like that. And you've seen, for example, in 1970s, as well as this past year, commodities, for example, did very well. And different commodity funds did really well as they were seen as an inflationary hedge, right? So it's very difficult to predict what the future holds, but you're potentially seeing that, the world we had is not necessarily the world we're going to have.
I think the types of questions that are on people's mind, because I'm getting it coming through the chat privately, are basically saying, so what should you do? Should you sit on cash and buy when the market drops? Or how else might somebody want to think about this if we're heading into a world of a lot of potential up and down?
Yeah, I mean, there are a lot of strategies to mitigate that. If we have time, we can touch into one of them. I actually did have a little bonus strategy of something I used to do that does really well during periods of high volatility. And if we have some time, we'll touch base into it. But I think it's good to be informed.
Got it.
Okay, let's keep covering some of this. So I think one of the most interesting things to think about is demographics too. And there's a very big difference between the demographics of what we saw in the 1970s and what we're seeing today. So you see here, starting in 1952, this is your x-axis. This is percentage in the y-axis. And basically in red is the amount of people that are 16 to 34 in the labor force. And in blue, it's the people that are 35 to 65 in the labor force. So you're seeing what happens here into the 1970s, peaking in 1980. The population was very young and coming into the labor force, coming into more earnings, spending more money, creating a lot of inflation. And then that amount of the population started declining, and the amount of people that are 35 to 65 or older kept increasing. So you can see that basically we've been flat there for a few years. So there is a lot of correlation that we've seen between the age wave, which again is the people that are 16 to 34 here starting in 1960, and the inflationary trend. Pretty interesting, right? And now we're seeing inflationary trend kind of rises. So we know we're in the demographic, the birth rate is below replacement rate. Immigration is relatively slow and sluggish. And we do know that it's very difficult to fight against that. So that's kind of the argument of why we won't see substantial inflation. And you can see the correlation too of the age wave versus the 10-year treasury. And we see that those have been fairly correlated. 10-year treasury peaked just a little bit after the age wave peaked and has declined since. But there is something interesting that I've noticed that could make this, could actually support higher interest rates as far as the demographics go. So we're actually seeing the labor force about to grow decade over decade into the 2020s for the first time since the 1970s, but obviously not at the same numbers or proportions. So look at the population growth in 1970 to 80, massive, and the labor force grows faster than the population. But now we're actually seeing population growth a lot slower as expected, but look at the labor force. It actually is slightly increasing over a decade ago. And why is that? This is the amount of people by age group that are expected to re-enter the workforce. So 1970, 1980, everybody's 25 to 65 for the most part. There's even a lot of people 16 to 24. We don't have those anymore. They basically dropped off. 25 to 64. But look at the 65 and older. The amount of people 65 and older still in the workforce and coming back into the workforce is expected to increase quite a bit.
Itai, do you think that's a trend that we're going to see on a go forward?
I think that makes sense because on one hand, people live longer, the quality of life is higher. People didn't live until 90 years old 30, 40 years ago. They lived until maybe 80 or 78. And also, it's unfortunate, but people don't have as much retirement saving, and Social Security is not as significant as it used to be. So now, if you're correlating that 10-year yield to the expected growth of the labor force, I think this is one of the most interesting charts. It's not just correlated to the age wave. That's the broad way of looking at it. But you can also correlate it to the labor force growth rate. So if you're looking at the projection of labor force growth rate, it actually is expected to peak around 2024 and only fall off afterwards. So we could actually see the next couple of years being inflationary before you're seeing a return to that long-term secular deflation or disinflation period. And that could support a couple of years of potential stagflation. Okay, I'm gonna stop right there and see if there's any questions about that. I know I've been talking for quite a while and I didn't get to cover everything, so I'll stop and see if there's any question on this.
Gold, silver, real estate chapstick. I love it. Rob Ross is he's on fire right now.
Well, we know precious metals did very well during that period until inflation peaked out in 1981. Isn't 1980 the year the Hunt brothers tried to corner the silver market?
Yes, it was.
So don't try to corner the silver market. I think it didn't end up well for them. Okay, I know everybody wants to hear about ways to make money. So I'm going to do a little exception here, and I'm going to skip a little bit of this that we'll cover in the next call. We'll talk about some of those that's really interesting and how technology can really impact that as well. But I'm going to give you a bonus trading strategy that I discovered did very, very well during periods of high volatility or high implied volatility. Did anybody hear about leverage ETFs?
Are you talking about the ones that eventually go down to zero after magnified losses?
That's right. But why did they go to zero?
Because because downside losses are substantially more handicapping than upside gains.
Well, actually, let's talk about it. Let's talk about the leverage ETF math. It's very simple, easy to follow. So imagine day one. Well, the roll cost is a factor too, but it's actually a small factor compared to just the way math works against them. There's definitely a roll cost, but it's not substantial if the markets don't have contango. So maybe it's like a SPXS, SPXL. Doesn't have a lot of contango, so the roll is not that significant. But a leverage ETF is basically an ETF that their mandate is to magnify the profits and losses of a specific market. So let's say you have, I'll give you the direction SPXL as an example. It's an ETF that's supposed to be 3 times the S&P 500. So it's like buying it on leverage. So if you buy $100 worth of SPXL, you're going to get 3 times the exposure to the S&P 500, and your $100 will count as $300 long the S&P. And you'll do that if you want to get some leverage. So you also have SPXS as an example. SPXS is a short position in the S&P 500. So if you buy $100 worth of SPXS, it's like being short $300 of the S&P 500. So the way things work with the magnified loss that Jeremy talked about is, imagine you have a perfect situation where you have on day one a non-leverage asset. So let's say it's the S&P 500 itself. And this would be a perfect 2 times ETF with no roll costs or anything like that. So imagine the market's up 25% in day one, and the perfect leverage ETF will be up 50% because it's 2 times whatever that asset does. But then imagine the following day, the market's down 20%. So the original asset is back to unchanged, right? Because it made 25%, now it's down 20. That means it's back to where it was. If it was $100, 125, and now back to 100. But a loss of 20% on a levered ETF, even if it had a 50% gain, is a loss of 40%, which means that it's actually down 10% from where it started. So you start here, back up to plus 50, and now you're actually down. So what does that mean in a world of many of these ETFs? So this strategy, I'll explain what this crazy chart looks like. And I know this is a complex strategy, so I'll give you a brief description of it. But if anybody wants to ask further questions, I'm completely okay with that. So imagine then you're short both SPXS and SPXL at the same time. So you're short an ETF that gives you 3 times the long exposure, and you're short an ETF that gives you 3 times the short exposure. And you're asking, why the heck would you want to do that? Wouldn't you make nothing? But the whole idea is take advantage of that inefficiency right there, which when they fluctuate enough, they hedge each other as they move one against the other, because when one goes up, the other goes down. But over time, they both suffer from decay, which will cause a profit for a short position. So this is an example of what that looked like in 2011 during the US credit downgrade. What you're seeing here is SPXL in orange. Throughout the whole year, it's a full year, it's 2011. What you're seeing is SPXS in red. And what you're seeing in white is the S&P 500 itself. So the S&P 500 finished the year up 2%, or just about flat. But because the year was very volatile, there was an upswing at first, and then there was a downswing later, and then an upswing again, and then it finished flat. You can see that the SPXL does 3 times the profit. SPXS loses 3 times, but then as the market goes down, they both go back to even. And during that enough times causes both of them to decay. So at the end of the year, SPXL was down 15%. SPXS was down 32%. So that strategy, if you're short both, gives you a blended profit of about 20% for the year on a flat S&P. Now compare that to the VIX. Very difficult to be long the VIX, and there's a lot of decay. The VIX starts the year at about 15 and ends the year at about 23. And it would have been very hard to have a strategy that profits as much from just being long the VIX itself if you don't go through certain things. So just to give you an idea of a strategy that can do really well during times of high realized volatility.
Well, for the few traders on the call, you made their day. For everybody else, they'll be digesting this one for a while.
Yeah, I know it's a pretty complex strategy. So I'm going to open this for Q&A about anything on the call, since we're hitting the hour mark.
Well, Itai, are there options on these 3X levered ETFs?
There are, but I wouldn't use them. They're usually traded thin, and you can use them to offset the ratio between the two. That's the way I would do it. But I wouldn't use them for just pure speculation. Because see, the whole idea here is if you're short this and short this, you see you have a gain here, you have a loss here as this goes up, but then you have a gain here that offsets it. Do you see? And then they're constantly hedging each other because they move inversely, but then you over time get the decay of both. So it's kind of a crazy strategy, but a lot of people lose money by going the other way there. So there's a lot of people that actually go long these ETFs for an extended period of time, and that's normally not a good thing for your P&L.
Well, Itai, I think that was pretty interesting, and the content was very interesting as well. And so I think maybe we can open up to questions. One of the questions that came in from DJ, can you expand upon the decay concept?
Well, there's some cost decay in these ETFs, SPXS and SPXL, but there are some ETFs out there like VIX ETFs that have a lot more decay because they have a contango inefficiency where basically the VIX trades 80% of the time in contango, and then they have a roll cost. Some futures have that too, like natural gas or oil. So imagine, let's think about oil as the easiest example. A lot of people intuitively understand that. So imagine oil is trading at $60 a barrel for today, and then let's say it's trading at $70 a barrel for the next month expiration. So an ETF that needs to buy oil is going to need to roll the contract to the next month before this current month expires. So they have to sell at 60 and buy at 70. So they're selling low and buying high. And then they do it the next month again, as long as the contracts are in contango. So over enough time, that creates a drag in the ETF. So the easiest way to look at it, you look at an ETF like USO. That's why USO has this like long decay over a long period of time. So compare USO to oil futures, and you would see that USO underperforms oil futures over a long period of time for that reason.
Cool.
But again, this ETF doesn't necessarily have that issue. That just have a mathematical decay.